Try you can see your screen, but we're not seeing your webcam.
I know it's a few minutes before noon, but I'm going to go ahead and begin with a few housekeeping notes. Welcome to the Bar Plan's Build a Better Practice series for April 2020. We'll begin the actual presentation in just a few minutes, but I need to go over just a few items, as I said, before we begin. First of all, please make sure that you visit the Bar Plan website at thebarplan.com. Click on the full menu tab and look at the upcoming Build a Better Practice events. I believe there's 4 events scheduled after this one for the rest of the year in August, September, October, and December. And wanted to let you know that in light of the coronavirus pandemic and the situations that are caused as a result of that, the Bar Plan has agreed to make the rest of the events regarding your ethics CLE credits free of charge for the balance of the year. So that's a great benefit to you. So no fees, all the fees will be waived for those particular seminars. Just a reminder that today's presentation will qualify for 1.2 hours of standard CLE credit in Missouri and Kansas, and 1 hour of CLE in Tennessee. I've also been asked to remind you that if you're in Kansas or Tennessee, you'll need to apply for credit. You do that by emailing your request to info@thebarplan.com. That's info@thebarplan.com. Include your name and your bar number in your request. I believe that information was shared with you on your invitation email, and it will also be included in the follow-up email after this presentation. Also, as we go through today's presentation, you'll have the opportunity to ask questions via the chat box. Hopefully you'll see to the right on your screen, or there is a question section as well. Simply enter your question and I'll try to monitor that as we go along and answer questions as they come in. We'll also have reserved a few minutes towards the end of the presentation for additional question and answer time. Finally, in the dialog box on the right, you will see a section that's entitled Handouts. And if you'd like a copy of today's presentation, you can click on that and you'll have a copy available to you. So again, thank you for joining us. We will begin the presentation momentarily. Okay, I have 12 o'clock noon and want to officially say hello and welcome you to the Bar Plan's Build a Better Practice series for April 2020. That's right, we're in April 2020. You've survived the longest month of March in history, I believe. My name is Larry Guess, and I am the Director of Exit Strategy Advisors for Plancorp, based in St. Louis, Missouri, and I'd like to thank you for joining us today. I'm going to be addressing the subject of creating a solid foundation for succession planning. But before I start, I did want to say a thank you to Susan Baltz, the Director of Marketing for the BAR Plan, for inviting me to share with you today, April 1st, otherwise known as April Fool's Day. Susan, had I given this serious consideration when I accepted your invitation, I might have declined, but I didn't, and I'm glad to be here. Also, a thank you to Joseph Allen, who's also in the marketing department with the BAR Plan, for making it possible for me to make this presentation remotely in order to be in compliance with social distancing guidelines. Hopefully you can see and hear the presentation fine. We've, I think, addressed all the technical aspects of this, but if there's any problems, we'll try to address those as they come up, and we would ask for your patience. It's a pleasure to have the opportunity to share with everyone joining us on this webinar, and I hope that you're all doing well in these rather unsettling times we find ourselves in the midst of. Before I begin the presentation, I wanted to provide you with a little background on myself, our firm, and the exit planning practice that I'm responsible for. Plancorp is a registered investment advisor providing comprehensive financial services as well as business consulting services. The firm began in 1983 and has over 1,400 clients located across the U.S. with over $4 billion in assets under management as of December 31st, 2019. Unfortunately, I'm afraid that number is probably a little lower today as a result of the pandemic. But hopefully we'll see a quick return to improved market conditions. In addition to our offices in St. Louis, we have satellite offices in Sarasota, Florida, Nashville, Tennessee, and San Francisco, California. Specifically, I spend 100% of my time working with business owners and helping them develop plans for transitioning the management and ownership of their business interests. I spent the bulk of my career working in various financial and operational managerial roles for both public and private companies. I've helped orchestrate and successfully implement growth strategies for those companies and ultimately assisted the owners in transitioning their ownership at the appropriate time. I myself have been an owner and have both acquired and sold a number of businesses in my career. I joined Plancorp in 2016 to begin our exit planning practice and have worked with all types of businesses, including manufacturing, distribution, services, as well as professional practices in creating and executing succession plans. Also, I am certified as an exit planning advisor by the Exit Planning Institute, which is based in Cleveland, Ohio. Two things I'd like you to keep in mind as we go through today's presentation. First of all, the ideas I'm going to share with you apply to all types of businesses, not just law practices. But there are some unique aspects related to law practices that I will be touching on. Hopefully you can use what I have to share in planning, not only for your own succession, but you also might find it helpful if you have the opportunity to talk with your business owner clients about their own succession plans. Second of all, I know that most of you participating in today's webinar are responsible for running your own solo or small firm, and while you may not think of your practice as a business, I'm here to tell you that you should, especially if you expect to be able to realize a value for the practice that you have worked so hard over time to develop. One other reminder as we go through the presentation today, there are tentative poll type questions that you'll need to respond to in order to receive credit. So, as we begin, I have a question for you. Why succession planning? To answer that question, I wanted to share with you some statistics that are based on business owner survey results provided by the Exit Planning Institute. First of all, when you get ready to sell your practice, you could get lucky and get a call from a strategic buyer, but only 3% of business owners do. A third of the companies that don't have a succession plan will end up shutting off their lights and liquidating for little or no value. And finally, one of the most alarming statistics that I've seen is that 3/4 of business owners report that they profoundly regret selling their businesses, largely due to the lack of planning. And when they dug into that a little bit further, what they found is that business owners really hadn't taken the time to think about the what's next after they were no longer involved in their businesses. What if instead you could create a succession plan that would allow you to do the following? To transition your ownership when you wanted to, the way you wanted to, and for the value you wanted to realize. We're going to talk about how to do just that. Let's start with one of my favorite quotes from Stephen Covey, one that you're probably familiar with. Begin with the end in mind. That very much applies to the topic that we're discussing today as you think about where you're at today and where you'd like to wind up. Succession planning or exit planning, and you'll find that I'll use those terms interchangeably today, is really nothing more than good business planning. That means assessing where you're at right now, deciding where you'd like to end up, and then determining the best way to get there. To do that, I'm going to share with you a basic checklist of ideas that should provide you with a foundation for your succession plan. But before we do that, we're going to pause for our first poll question. Okay, I think that we've successfully completed the first poll question and are ready to resume our presentation. So there are 5 critical elements to this planning process, and we're going to spend some time looking at each of these today. You see them listed on the clipboard on your screen, hopefully. The first one is, what is the current value, if any, of your practice as it sits today? And more importantly, how do you objectively determine what that value is? The second item is, what are specific things that create or drive value in your business or practice? The third element really has 2 aspects to it. One is setting goals for what you'd like to achieve in this succession process. And the other is, what are the exit options that are really available to you? And then most importantly is to tie those 2 aspects together, understanding what options will enable you to accomplish your goals. Most importantly then is to tie these two aspects together to achieve that outcome. The fourth element is, like any good plan that will take some time to implement, you'll need to be able to measure your progress as you proceed. And then finally, in all likelihood, you'll need to involve others to be a part of your execution team. Now, I want to give you one warning that comes along with this checklist, and that is that the biggest enemy of planning is procrastination. Procrastination often leads to undesirable results, but action taken today can lead to better future outcomes. If I had to identify one element that creates issues in this whole succession planning process, is putting off today what really needs to be addressed, putting it off until tomorrow, but instead of doing it today. In the words of Benjamin Franklin, an ounce of prevention is worth a pound of cure. Couldn't be more timely words, especially considering what we're experiencing today. Now let's take a few minutes and dive into each of these items on the checklist a little bit further. When we talk about establishing current value, we're referring to having a third-party valuation specialist provide you with an independent, objective opinion of value. That's very important what I just said, independent and objective. We find that most business owners really don't have a good grasp on what their business is worth, especially they may have an emotional aspect to that valuation in their minds and be overvaluing what the business realistically could be sold for. There are a number of different types of valuation specialists, and you're probably familiar with those designations. I'll just tick through them. Some of you may even have these designations. The first is an ASA, an accredited senior appraiser, which is conferred by the American Society of Appraisers. The second is the ABV, accredited in business valuation, conferred by the AICPA. We have the CVA and AVA, which stands for Certified Valuation Analyst and Accredited Valuation Analyst. That's conferred by the National Association of Valuation Analysts. And finally, the CBA, which is a Certified Business Appraiser. When we think about valuations, there are a number of different types of valuations. We typically utilize one of the two that I've listed here, either a conclusion of value or a calculation of value. The conclusion of value you may be familiar with is a very comprehensive valuation report that is accepted by the IRS and often used in estate planning to arrive at valuations that will be used in tax planning. The calculation of value is really more a series of reports and exhibits that will be used primarily for a planning purpose, such as what we're talking about today, and will enable us to identify a realistic value for the business that's under consideration. Both types of valuations will normally use the same methodologies, and I've listed three of those here that we typically see. Those are the income approach, the market approach, and the net asset value approach. The income approach typically involves either a discounted cash flow calculation or a capitalization of earnings calculation. And the concept is to really look at the historical earnings of the business, project those on a go-forward basis, and be able to come up with a value that would be a reasonable value a third party would be willing to pay for the business, given the risks that are involved and the potential future earnings of the business. The market approach is really looking at historical data for actual transactions that have been completed for similar type businesses, making adjustments for size and other factors, being able to, in essence, provide a comparable value for businesses similarly situated based on different metrics. Those could be a multiple of the earnings before interest, taxes, depreciation and amortization. It could be a percentage of the revenue being generated, or a multiple of the seller's discretionary earnings, which we'll talk about a little bit later. And then also I've mentioned that if there's real estate involved in the transaction, there may be a need to have a separate real estate appraisal completed. And many of you may operate out of offices that you own, and if that's going to be a part of the transaction, then you'll want to understand what that value is separate from the business itself. Also, I skipped over net asset value approach. That's typically looking at the value of the assets that the entity owns, less the liabilities that are outstanding against those assets. And that approach typically will arrive at the lowest value as it doesn't take into consideration the goodwill value that the other two approaches might take into consideration. So when we think about what drives value in your business, there are many factors that can be a part of that. I've listed 7 factors that we're going to look at today in some detail. Profitability, growth potential, diversification of client base, future cash flow requirements, recurring revenue sources, competitive advantages, and client satisfaction. So let's take a look at each of those separately. To begin with, profitability. Obviously, that's just looking at the net income that the business has generated, but factors that go along with that that will impact the value of a business are the relative size of the revenue being generated and the trend. Is it increasing or decreasing or volatile over the last several years? And then what are the expected future profits that the business is going to be able to generate? And what's the basis for assuming those future profit levels? And then are there good financial reporting systems in place that provide for accurate information? When I talk to owners about this concept of profitability, I often break it down into 3 components: reliability, sustainability, and flexibility. And by those, I mean reliability is really looking backwards at the historical financial information and how accurate and reliable is that information. Are the expenses and revenue numbers being reported accurate? Are there expenses that maybe aren't a part of the business that need to be adjusted for? Are there things that are not being accurately reported from a timing standpoint? Sustainability really is the concept of forward looking to say, okay, we've realized a certain level of profitability in the past. How likely is it that we're going to be able to sustain that level of profitability in the future? And then flexibility has to do with understanding the components of the business as you get closer and closer to a transaction or transition of ownership date that might be ongoing responsibilities, such as contracts. And you may want to consider, as you get closer to those target dates, reducing how far out you've committed, either for lease space or equipment that you might be renting or other commitments contractually with clients. Making sure that you're not going to be responsible for ongoing expenses after the transition date that the acquirer would not be interested in assuming. The concept of adjusted earnings is also one that I touched on a little bit, but really looking at your expense numbers and seeing, are there expenses that are included in those numbers that maybe would not be expected to be ongoing expenses of an acquirer. Many times business owners are putting expenses through that are there to reduce the profits, and it becomes very complicated to separate those out. And so you need to be tracking those as you get closer to a transition date. And then I mentioned this idea of SDE, or seller's discretionary earnings. Because there's compensation being paid and then there may also be profits being distributed, it becomes very difficult sometimes to draw the line between those two, and to avoid any complications there. In the valuations, the adjustments are made to look at just the overall income, adding back whatever the income is that's being paid to the seller, so that we're really looking at the cash flow of the business without the expense numbers for the owner. And then the next area would be growth potential. So looking forward, again, what is the opportunity to grow your practice or your business into the future? One of the things we often find is that business owners have great ideas of how they might be able to increase revenue in the future, but they've never really taken the time to sit down and document what that might include. So thinking about those opportunities, where they might lie, whether it be in geographical expansion, new services or specialties that you might be able to hire, maybe additional attorneys in your particular case that you might have your eye on in hiring in the future that would bring additional services to your firm, or maybe even looking at acquiring another solo practice or a small firm. Other areas that we examine in value drivers are thinking about the diversification of your client base. Acquirers are considering what risk there might be to being able to sustain, as I mentioned earlier, your revenue base. And so if you have a lot of your revenue that is concentrated in a small group of clients, that could wind up being a discount in value. So you can increase the value by having a good dispersion of business across a number of clients. One sort of metric there is typically 10% of revenue being concentrated in any one particular customer or client. And you want to make sure you are able to explain why that is expected to be a solid relationship on a go-forward basis. You may also want to think about specialty services that you could explain to any acquirer, that really contribute to the stickiness or the concept that that customer or client is going to stay with you in the future. Another area is future cash flow requirements. We have a favorite saying in our office that cash is king, and an acquirer is really interested in what is the future cash flow that they're going to receive for whatever investment is that they make in the acquisition of your firm. And so they're going to be looking at things like, what has the cash flow trend been? Has it been improving or declining? Is it stable and predictable, or is there an erratic nature to the cash flow of the business? And then an area that I'm sure does not apply to anyone on this call, but is the timeliness of your billing and collections. Are you getting your invoices out to your clients on a regular basis shortly after completing work for them? And are you staying on top of the collections? Or are your receivables being extended beyond what would be considered acceptable number of days outstanding? And then another area is just this idea of recurring revenue. Can you demonstrate that a portion of the revenue that you are reporting on an annual basis is likely to continue to recur because it's under a retainer relationship with specific clients, or maybe you have contracts with them for services that you're providing, or perhaps you have some annual service that you're providing, like checkups on estate planning documents. Anything that you can demonstrate to an acquirer that you have in place to make sure that revenue is recurring will add value to the business. And then two last areas that we often look at are competitive advantages. Think about this as, what's the reason that your clients come to you instead of going to someone else? And can you articulate that? Is your practice known for providing services at a low cost? Or is it known for the quality of the services that you provide, or the types of services that you provide? Warren Buffett often refers to this idea of widening the moats. In other words, are there things that you can explain to any acquirer that you have done to differentiate your practice from a competitor's practice. And then this idea of client satisfaction. To what extent, excuse me, your clients are satisfied with the services that they receive from you, and are you able to gauge that in any meaningful way? Fred Reichholt, who's known to be an expert in this area of client surveys and satisfaction, says it really boils down to the ultimate question of, on a scale of 0 to 10, how likely are you to refer a firm to a friend or colleague? So have you asked any of your clients that question? Can you demonstrate what their responses would be with regard to a question like that? A couple other things just to keep in mind is, as you're thinking about reviewing what's gone on in your practice over the last several years, are there any trends that would need to be explained either up or down, or any exceptions that occurred? And if you think about extraordinary type of events that may have occurred in your practice, it may be important to document those so that you can recall them and bring them to the attention and explain why they may have impacted earnings in a negative way, so that they won't be a discount factor in the valuation of your business. And then run your practice on a day-to-day basis as if you intend to sell it at any point in time, so that you're ready to do that no matter what the circumstances are. So the third item on our checklist, and a key element in succession planning that we find is often overlooked, is taking time to stop and think about what it is that you really want to accomplish as you transition out of your practice. Something that we found very helpful is to think of goals and objectives in 3 different segments, which I've listed on the screen. Foundational goals, universal goals, and value-based goals. And then you need to consider your succession options. We think of those as internal options and external options, and we'll dive into that a little bit deeper here in just a second. But once you have once you have identified those goals and options, then you need to tie the 2 together and make sure that you're selecting options that are most likely to achieve the goals and objectives that you're looking to achieve. So let's talk about these goals and objectives. First of all, we have the foundational goals. So if you think about what were the reasons that you went into practice for yourself to begin with, probably one of those would be that you wanted to be in control of your own destiny, specifically your own financial security. And so that is normally a foundational goal that all business owners have, is they want to be able to be in a position whenever they sell their businesses or transition out of them, that they're financially independent. And so being able to analyze that is very important, and knowing with confidence that you have reached that point will be important to setting your goals and objectives. Then there's 3, what we refer to as universal goals that most all business owners share. One would be, when do I want to leave my practice or business? Who should own my practice after me? And how much do I need to sell my practice for? And then there's value-based goals. I've listed a number of those here for us to talk about. I break these down into value-based goals that are related to family harmony. And I'm going to give you a little bonus material here. When we think about family harmony, we're thinking about things like, are there other family members that are potentially involved in the business that would be impacted by your selling of the business? What's going to happen if you're no longer spending the 40, 50, 60 plus hours a week in that business? How are you going to utilize your time? There's only so much fishing and golf that you can fill your time with and still be satisfied or fulfilled. I personally am kind of going through a test of this right now. Working from home the past 2 weeks is a little bit different environment and putting my marriage to the test. And my wife shared this next slide that I'm going to share with you. Hopefully you'll find this in good taste. It says, quarantine for hubby for 2 weeks. Gertrude is knitting something special for him. And hopefully you can see that that is a noose. I sent that to someone and asked if I should be concerned that my wife has recently taken up knitting. But in all seriousness, you need to have had those discussions and maybe talked about spending time together as a family that is more time than you've ever had in the past. Maybe taking a longer vacation than normal, just to explore how you would utilize that time and are you ready to do that? So don't underestimate this whole idea of family harmony. Owner legacy is thinking about things like you've built a practice and had a certain reputation, and you want to make sure that your clients' needs are going to be met after you're no longer involved with the firm. And the type of reputation that you have in the community in which you work is continued on in an appropriate way. Maybe acknowledging employees and thanking them for their service over the years and helping you build a successful practice will be important to you, either in the form of some type of bonus arrangement or making sure that they have employment with the acquiring firm. Sometimes it's just growing the business to a new level and bringing your practice into one that's larger, that has other services that are needed by your clients. Tax minimization can be important as you think about the goal of what you want to wind up with as a net after all of the transaction work is completed. Maintaining the culture that you've developed for the people that are working in your firm. Maybe you've been one that's been actively involved in your community and supporting different efforts, and you want to see that continue. That can be important also. Understanding retirement and what some of your goals are in retirement and being able to have the ability to live out a quality type of retirement. Maybe you've put off doing things like travel or other areas of interest that now you will have time to do, and being prepared to do that. And last but certainly not least is the idea of having charitable intent and how you might go about accomplishing some of the things. And that might not be only financial, it might be spending some of your time and expertise in supporting a charity by serving on a board or being involved in a fundraising effort. As we think about tying the transaction options to the goals that you've established, there are 3 questions I want you to keep in mind. First of all, from a risk standpoint, if I look at the options available to me, does the options that I'm considering increase or decrease the risk to my financial security? Second of all, control can be very important. Under certain options, I may lose all control as to what happens afterwards, versus others, I may have the ability to control that for a period of time. And how important is that to you? And then last but not least is, how does the particular option that you're considering impact your ability to achieve those value-based goals that we just considered? I'm going to pause here, and we're going to have our second poll question. It'll take about a minute or 2 for you to answer that, and then we'll continue on with the presentation. Okay, I've been asked to read the question out loud. It is, which of the following is not an example of a value-based goal? There are 4 choices there: family harmony, minimize taxes, financial security, and acknowledging employees. I'm sorry, apparently we had a different poll question. And I'm not able to see the poll questions, so I'll let you read that and respond with the response. Oh, apparently the question is, which of the following is consideration that is specific to a law practices? Client notification, ethics, malpractice, insurance, or all of the above? We haven't covered that yet in the presentation, but if you want to go ahead and you may know the answer to that since it's specific to the practice of law, and we'll come back to that question in a minute. Okay, looks like that question has been closed. We appreciate your responses. The answer to that is all of the above. And again, we'll go through that in a little bit more detail in a minute. So as we think about tying transaction options to goals, we need to examine those exit options in light of the goals and objectives. And we need to think about the different types of options that you might want to consider. First, we're going to look at internal options. There are 4 that I've listed here. Not all of these will necessarily apply to the practice of law, but I wanted to go ahead and put those out in case that you might be working with business owner clients and find this helpful. Typically, the internal options we're talking about are family succession, partners, key employees, are ESOPs. The external options we typically consider are third-party sales, private equity, and family office. So when we think about family succession, what we're talking about is transfer of ownership to direct heirs, usually children, could be brothers, sisters, nieces, nephews. An interesting statistic, 50% of business owners want to exercise this option, but in reality, only about 30% actually do because there are a lot of complications sometimes in being able to successfully do a family transition of ownership. Partners, we're talking about being able to transition the ownership to your business partners, and keep in mind that the success of doing this is closely linked to the existence and quality of a buy-sell agreement. It's not available to single owner businesses. Key employees could be that you have others involved in the business who are not actually partners yet, but want to be able to have a transition plan that ultimately they would become partners and be able to be your succession plan in owning the business. And then an ESOP. The company uses borrowed funds to acquire shares from the owner and contributes those shares to a trust on behalf of the employees to set up an employee stock option plan. So let's talk just a minute about the pros and cons of each of these types of internal options that I think might apply in your situation. One would be the family succession. So some of the pros of that is it does often help to preserve the legacy that you have created in the firm. It can be planned out normally fairly easily because you're dealing with somebody who's already familiar with the firm and your practice. Normally, you don't have to involve any third parties in the transaction, so it can be the lower cost option. You certainly have more control over the whole transition itself. It can be less disruptive. And typically, there's a pretty high motivation for both the buyer and the seller to complete the transaction on a timely basis. Some of the cons, there can be family dynamics, emotions that get in the way, and people get feelings hurt. So that can be a complicating factor to keep in mind. Many times the family member that you are considering transitioning ownership to does not have any liquidity to be able to make a payment for the business upfront, maybe over a period of time. It may result in you taking a discount on the price to be able to make the transaction work. In something that many people don't think about, you may have key people that work for the firm because you're there, and if you're not going to be there, they may be thinking that they don't have the same respect for whoever it is that you're thinking about transitioning the ownership to, and you may incur some risk of flight. This can be something that you're just trying to do from a tradition standpoint and keeping the firm in the family, so to speak, but it may be something that really is not a great strategy. Oftentimes, owners pick this because it's a path of least resistance, not because it's the best path to growth or success. From a partnership standpoint, this can be considered a good option for a couple of the reasons that I've listed here. It can be less disruptive, it can be well planned. You have buyers who are well informed because they're active in the business day to day. It can be a controlled process if there's a buy-sell agreement in place and it's been updated. That's an area we often find buy-sell agreements are initiated early on in the partnership and then never revisited. And unfortunately, they may not really express the intention of the parties when it comes time to really do a transition of ownership. It can be a lower cost option as well. Some of the complicating factors is it may result in a lower sale price depending on how the transaction is structured under the buy-sell agreement. It can sow discord if people are not getting what they expected. There can be competency gaps, especially if you think about specializations that you may have and your partners may not have, and how is that void going to be filled in the future. There can be specific restrictions that are in the buy-sell agreement that you hadn't contemplated, and the realization of the proceeds from the sale may not happen all at once. You may have provisions in the buy-sell agreement to be paid out over a period of time. So when we think about the external options, we talked about third-party sale, where you're selling the business to a strategic buyer that is interested in acquiring the company because of synergistic value it will bring to the existing business or practice. Private equity, one that typically doesn't apply to the practice of law, but one I wanted to at least again get on the table for you that might be dealing with other business owners contemplating succession. That's where the owner sells all or part of his interest to a financial buyer that's interested in growing the growth potential and is looking to sell the business at some point in the future and get a higher return on the investment and the original investment that they made. And then a relatively new option is this idea of using a family office where you're selling, again, a part or all of their interest to a private firm that manages those investments in trust for a single family that may be looking for alternative investment options to include in their portfolio. I'm just going to quickly look at some of the pros and cons related to a third-party sale. Typically, this is going to generate the highest price because they're seeing this as an opportunity that will add value to the existing business or firm. Typically, it will result in more cash being received by the owner upfront. Also may give you the ability to turn the keys over and walk away immediately or on a much shorter time frame than the other options. Usually the deal terms are very well negotiated and they're very stable and don't shift. And it can be an opportunity for what I call business refresh, sort of bringing a new energy to the practice. Some of the cons are it can take a longer period of time, especially depending on the sophistication of the acquirer and their due diligence process. Typically, we see that process running 9 to 12 months. Because of the involvement in that due diligence, there can be a distraction factor, a loss of focus on the business, which can be a danger. Certainly, privacy concerns are something to keep in mind, that you're dealing with a third party and making sure that everything is being kept confidential. It can be emotional for the owner as they go through this process. There can be certain restrictions after the sale that tie the owner's hands. There's usually more cost involved in this particular option because of the third parties involved, and there can be complexities and it can be difficult to close. So specifically, and this gets to the earlier poll question, sorry we had those out of order, but there are some specific things that I wanted to bring up with regard to the practice of law. And as you're probably aware, in 1990, the ABA Model Rule 117, sale of law practice, was adopted. And that provided for the sale of law practices, provided that certain conditions were met. And this sale does include being able to include a value for the goodwill. Some of the areas that I listed here that you want to keep in mind are ethical considerations. So client confidences, making sure that information you have on your clients and the work that you're doing for them is kept confidential, making sure that the successor is competent, and that if there are any covenants not to compete, that those are well thought out. With regard to client notification, there are very specific rules regarding a notice that contains information on the proposed sale, including the client's right to choose other counsel and authorization of any proposed changes in fees, as well as a presumed consent if no action is taken by the client within 90 days of receipt of the notice of the transaction. Things to keep in mind with regard to valuation and terms: obviously there'll be some value for hard assets that are being transitioned in the transaction. There'll be some value in work that is started but not completed, so work in process. There'll be value in the receivables that have not been collected, and then some goodwill value for what you've created in terms of the client base that you have. There could be a formula for determining value, and many times, especially in the practice of law, there'll be some concept of tying payments to future earnouts based on future revenue or client retention. And then the last area I wanted to bring up is malpractice insurance, which I'm sure most of you have, but this idea of tail coverage. What is covered after the transaction? This is a very important protection that you'll want to avail yourself of, and I'm sure the folks at the Bar Plan can assist you in this area. The fourth area in our checklist is measuring performance. So we want to select the most likely exit path after you've done that consideration of options and goals, and then manage towards that end. So if you're going to do a family succession, being able to start conversations around that and preparing for that. If you're going to do it with partners, the same thing, or maybe even hiring somebody who you anticipate will develop into that partner who will become your ultimate exit strategy. You need to understand the benefits of strategic planning process, and maybe even consider an advisory board. We have helped implement those in a number of cases and found those to be beneficial. And then you need to measure performance regularly against your plan. So if you know that you need to get to a certain size, or some of the other goals and objectives are very important to a successful outcome for you, then set some milestones along the way to make sure that you're actually achieving those things that you set out to achieve. And then last on our checklist was to execute a plan with a team. We think you need to develop your transition plan not in a silo, but using an appropriate team of advisors. And those might include organizational development and process improvement consultants, maybe assistants in business development or marketing in your case, working with accountants to really do tax projections, to have a good understanding of what the net proceeds of any transaction might look like and how that might affect your personal financial plans. Working potentially with investment bankers or brokers to identify potential acquirers for your firm. And then working with folks that specialize in exit planning that might be able to guide you through this process and be the quarterback of your team. We believe very strongly that it's important to have a team approach, that two heads are better than one, and being able to incorporate each of these areas of specialization will enable you to achieve a better outcome along the way. And then last thing that I wanted to bring up was this idea of contingency planning. You can have the greatest plan in the world, but if something shortcuts your ability to see that plan through due to your own incapacity or death, how is that going to affect the outcome for your heirs or those responsible for the continuation of your law practice? Some of the things that we find need attention are shareholder agreements. I mentioned updating those buy-sell agreements, making sure that they really do state what your intentions are. And then estate planning documents, making sure those are up to date. We often find that business owners have not either done wills or set up their trusts, their revocable trusts in an appropriate manner, and maybe they conflict with what their intentions are with regard to the business ownership. So having those up to date and understanding what's included in those documents is very important. And then also communicating what's in those documents to those who might be ones who will be involved in the actual outcome. Employment agreements. It can be important sometimes to make sure that your key people have agreements where they understand what the transaction impact might have for them, and making sure that you can demonstrate to the acquirer that they are going to stay involved with the organization. And that may include stay bonus arrangements or other types of agreements that would be considered positive impact in planning for those people that you consider key in your organization, and making sure that they're well taken care of at the end of your time involved in the practice. And then there could be salary continuation programs that you need to consider, especially if you have a firm where there are partners or key people involved. I can't tell you the number of times that I've run into problems in this particular area where you've got people that are high income earners, and they may have some form of disability insurance, but only covering a small percentage of their total income. And it can be very important to have an understanding of what the firm is going to be responsible for in the event of incapacity, or having life insurance in place that's adequate in the event of death. So those are just some of the things that you need to make sure you have in place and are or have been updated appropriately, to make sure that if in the unexpected event of your inability to carry out your responsibilities due to incapacity or death, those things have been well prepared for. So at this point, I think we're going to go to our third polling question, and we'll get that up, and then I will read that for you. Okay. So that final question is, which of the following is not an example of a value-based goal? Family harmony, minimize taxes, financial security, or acknowledging employees? I'll give you just a minute to answer that question. Okay, so the answer to that question was financial security. Family harmony, minimizing taxes, and acknowledging employees are all examples of value-based goals. Hopefully you got that question right. We apologize for the out of order of those polling questions. we thought we had most of the technical aspects addressed, but that was one that escaped us. So just again, reviewing our checklist of succession planning elements is establishing the current value of your business, knowing what it's worth today, and being able to see if that is adequate or if there's a gap in the value that you need to be able to achieve. Determining what drives value in your business. If you need to increase value, do you have the time, and are you prepared to implement changes that will increase the value? Thinking about the various transition options that we discussed, and how do those tie to the goals? And have you taken time to really sit down and write out your goals and consider all the different types of goals, not just the financial ones, with regard to a successful exit of your ownership of your practice? And then have you set certain targets that you can measure and know if you're on track or if you're falling behind? If procrastination is becoming an issue, this is going to be a very important element to get you back on track. And then being able to execute your plan with a team. We think it's, again, very important to not try to go it alone, and be able to utilize some of the expertise that's out there to help you in a successful transition in preparing for your succession. We're going to open it up for questions, and if you have a question, please make sure you go to the chat box and enter that question. We'll try to answer those to the best of our ability. And if there's any follow-up, I'll be happy to converse with you separately on that. So we do have a first question, is how long does the planning process typically take? And I wish there was a good answer for that. It really varies. There can be a number of different factors. I would say typically we will see that process take anywhere from 6 to 12 months to go through start to finish a very comprehensive planning process. And there are tools that we have available to assist with that. For instance, we have an assessment process we go through that really helps owners in identifying those goals that they may have. And so that's an area that we're more than happy to try to assist in. We can move the process along as quickly as possible, but we understand that there's a business that you're still trying to run and function in on a daily basis. So we'll move on to the next question. We've got a number of questions here, so I'll try to, we're obviously probably not going to get to all these in the allotted time. I'm more than happy to stay on and try to answer those questions. And feel free to stay on. And I think we can keep the session open for a few minutes longer to do that. The next question was, when should a business owner start the succession planning process? We always jokingly but very seriously say it's never too early to start the process. And that goes back to that Stephen Covey quote about begin with the end in mind. It's very important that you really make sure you've allotted enough time to carry through the process adequately and do it in a very comprehensive fashion. So we like to see at least, if we can, 2 years prior to the time when you no longer want to be involved in the business. And understand transitioning ownership and being involved don't necessarily have to take place at the same time. There can be 2 distinct time periods, but that's an important goal, is really setting your time targets and then providing adequate time. And especially if you need to be making a number of changes in your practice prior to transitioning ownership, the more time you have available, the better. What are the biggest problems you see with internal versus external succession options? We covered some of those in the pros and cons, but I guess from an internal standpoint, usually the biggest obstacles or problems that we see is a lack of communication in waiting too long to start that discussion. And so participants in the process getting false expectations, and then only to realize that there's a lot of now corrective action that's going to have to be taken, and that may have to be taken in a very compressed time period. And that's where the family dynamics or the partnership dynamics can become explosive and derail the process. From an external standpoint, a lot of times what we see is that the third parties are not necessarily on the same page when it comes to value or in terms of the way the transition process is to be handled. And so they get into disagreements about those types of things, and specifically disagreement over the value of the practice or how that value will be determined and paid out into the future. The due diligence process can be one that can be very time consuming and can be complicated. And so a lot of times that will also be a problem to a successful outcome using a third party. We're at the 1 o'clock mark, so I'm just going to say thank you again to everybody for joining us. Hopefully this has been helpful for you to be able to use in your own succession planning thoughts, as well as maybe even being able to use it with other clients. There's a few additional questions. I'm going to continue on, and we'll try to answer those for those that would like to stay on. Otherwise, have a great day and stay well. The part B question to what are some of the biggest problems are is how do you overcome them? Again, going back to the internal communication, is really starting to sit down and talk about who should be involved in the communication process, what should be the frequency of that communication process, and getting into a rhythm of talking about those matters that are going to be important and not pushing them down the road or kicking the can down the road, as it were. From an external standpoint, again, it's all about setting appropriate expectations and then being able to move towards a successful outcome, controlling those expectations in a timely fashion. Are there any blank forms that you could share that would be helpful to meet some of the goals and plannings you discuss? There are a couple of those that we can share out, and I'll get with the bar plan and try to share those that might be helpful in that process. There's a comment I'll share. It says we do a lot of succession planning for our business clients. It's nice to turn the focus on ourselves, which is easy to let slide. I think that's important observation, sort of like the mechanic who never gets around to working on their own car. And we see this a lot in professional practices where folks are giving recommendations to others, but not taking their own advice. And so I would hope that today has maybe sparked some interest in your own ideas about how you might be able to incorporate some of these ideas in your own planning process. I think that covers the questions that we've received. Again, if there's any follow-up questions, feel free to submit those. I thank you for your time and attentiveness today. And again, if I can help, my contact information is in the presentation. Feel free to reach out to me at any point in time. Everyone have a great day.